Michael Dix, Head of Research at Barclays Wealth. Michael, thank you so much for coming in. Now, it does seem that actually if we look at a poll done by Bloomberg on investors and also companies, they seem to suggest that actually growth is going to be in the US, and that's where you should be in terms of equities and stocks. Is that where you would place your portfolio?
It's certainly one of the things that we like. So we are sort of still pretty fully invested. Where we took risk off the table, I guess going back a few weeks now, was actually in Europe. So Europe feels a different story. If you look at those Fed forecasts, they're thinking of growth with a 4 handle next year. I think it's more likely to have something like a 3% type growth rate, both through the rest of this year and next. So it'll be a little bit disappointing, perhaps, I think, to the Fed, but still pretty decent growth in the US. We're not going to see 3% growth anywhere in Europe.
But Michael, talk me through, we were expecting growth here in Europe, but then we had some kind of, punishment because of Greece, what Mr. Rubini calls a bond vigilantes, zoning in on the Eurozone. Now, the debt in the US is not any better than in Europe. Do we not risk actually investors going against the US very quickly?
Well, I think we do run the risk that it becomes an issue. I think last week President Obama gave a speech where, in a sense, he's putting fiscal tightening on the table. And I think there's a presumption, and I think probably rightly, that it's next year, hopefully after another 6 or 9 months of pretty strong growth, and that unemployment rate is at least beginning to decline. And as Mr. Bernanke said, not down to 8 or 7%, but maybe down to 9%. Then the economy may be strong enough to be able to withstand some fiscal tightening. And maybe you won't, in a sense, get into the situation we're in Europe, where we're having to try and keep those bond vigilantes happy with more and more tightening. Almost every day that goes, we get more fiscal effort from someone. And the real concern in Europe is that's too soon. It's before the economy really has got sort of a take-off trajectory to it.
So are you concerned that actually we may see a double-dip recession here in Europe?
Well, I think in parts of Europe almost for sure. So if we take Greece as the extreme case, it's almost impossible to imagine a situation where it doesn't. Spain's right on the cusp. So I think, yes, quite likely it'll double dip, but it may not be too severe. And it may not feel too bad. The difference between mild slowdown, if you like, mild double dipping, and mild growth is not that much because unemployment stays high and carries on rising. I think the key is whether the stories we've been seeing about German orders, that despite that funny export number, is still showing through in very strong growth for German export. Is that strong enough to have your core of Europe, if you like, still maintaining decent growth? And I suspect it will, because I suspect that weakness we've seen in the euro will maintain that support, if you like, for strong growth for German companies, and that will allow Ms. Merkel to do that mild fiscal tightening, 0.5% of GDP, that in a sense takes the gloss off growth but doesn't actually push you into a double dip.